and I want to welcome Rohit back to F.A.C.E. Welcome back, buddy. It's been a long time.
Hi, thanks a lot, Dale, for having me here.
So see how popular you are. I try to, forget about you, and your fans come in and say, bring Rohit back, bring him back. So great to have you, because I remember your analysis. Are you going to be sharing your screen today, buddy?
Sure.
Okay, so it's a green box. I'm sure you've used Zoom in the last few years. Everyone has used Zoom.
The last time we did this, my wife heard you speak and she fell off the chair. She really loved your voice and the way you conduct the entire session. So it's really wonderful to.
It's great to be back. Tell me if my memory is good. Like, I remember when we first started talking, you had a narrative of disinflation, and you were kind of bearish. And then it was, I think, what was it, a year ago or longer since we talked?
June 2020 when I made the switch.
Gosh, almost 2 years. So I remember back then you had flipped. You said, Dale, I'm not bearish anymore, and I think inflation is coming back to the markets, and you were bullish equities, and that was a
commodities.
Commodities, and that was a great call. You were ahead of the curve. So how about now? Where are we at? Do you think commodities can take a breather?
So I think we are at a very, very good, interesting juncture because of a lot of what has happened recently. We definitely had what I called in May of 2020 the reflation trade, which meant that the dollar would fall and would drive up asset prices across. And now in the last 1 year, we've also had the correction in the dollar. The amazing thing with this particular dollar rally is that, and say I called it a correction, even though it's a rally, is that it hasn't had all the same side effects that it had in the previous dollar rallies that we saw between 2009 and 2020. So I continue to call it a counter trend move because commodity prices have been rising along with the dollar. Precious metals haven't really sold off that badly. And in the last 1 month, thanks to the unfortunate Russian and Ukraine crisis, we've ended up with a lot of sentimental extremes in many of these markets simultaneously. And I'm referring to, of course, the daily sentiment index published by Trade Futures. For the dollar index hitting 92% recently, but simultaneously, you saw the S&P hitting, almost 11, 12% or 9% at one point of time during this sell-off. We've also seen that in oil, consistent readings at, over 90%. And so all of these things happening simultaneously are telling you that, many of these markets are going to reverse simultaneously, and you're going to get some meaningful trends on the opposite side. And when you look at the big picture, and you go back to the big picture biases, what should that meaningful trend be? So it should be a resumption of the dollar bear market, a resumption of the commodity bull market, and a preference towards emerging markets. So that whole trade, which had sort of seen a minor setback in the last few months, I think is just waiting to come back, is how I'm looking at the whole thing.
Okay. All right. So what are you showing, some charts, or you? Okay. Okay.
So of course, we try to measure the market. I use a lot of Elliott wave for cycles and also use momentum cycles with my own momentum indicator, which is sort of a smoothed rate of change. And the idea is to be able to see the market in terms of sine waves. So that is why I've put this chart up. And I also then use for the very long-term understanding of this deflation or inflation theme is to study the economic cycle, which is also known as the quantitative cycle or the long wave. And over a 50 to 100-year period, we expect it to go through periods of spring, summer, autumn, and winter. So the whole debate, I think, between that deflation to inflation shift in my mind was, because of all the debt problems, if we really had to have that collapse in asset prices, it should have happened during a strong dollar environment, which was prevalent from 2009 to 2020. And so I was still on the winter camp. And once, I think 2017, it became sort of first time clear that the dollar was entering a bear market. It did fall. Commodity prices rose, or even metal stocks in India did pretty well. But then all that sold off, and then you got a double top, I think, in 2020 March, which was the sign that maybe things will turn. And that double top came after lots of readings. I think almost for a year, the dollar index gave readings of 94%, 96% on the sentiment. So I have that chart. I'll come to that. And
so what season are we in here?
So I sense that, and specifically for India, more than the US, I think India lags the US by around 8 years or 10 years in terms of where we are in the economic cycle and the kind of events that we get. For example, the US had the GFC crisis and the banking crisis in 2008-9. India had its own banking crisis between 2016-17 all the way till 2020 with rising non-performing assets and a non-banking financial market crisis, which then was bailed out very similarly, much smaller in scale.
Was that also the time that Modi
was re-elected?
Some notes? It wasn't Modi?
Yeah.
Where he made certain notes, took them off the market, certain cash, denominations, and was that part of the crisis?
Well, that did not cause the crisis because it played a role in sort of putting a pressure on stopping a lot of cash trades that take place in India. A lot of the economy runs on the cash market, and that sort of put a halt to that. But I don't think that is the reason why it happened. It had a lot to do with the previous business cycle. India had a boom between 2003 and 2011 in places like infrastructure, power, and many of those assets were stuck. But they were not being recognized as non-performing assets by the banks till the then Governor Raghuram Rajan said banks have to recognize it, and they recognized it in 2016, and then that led to the subsequent crisis.
I'm curious, in that experiment, has cash tax receipts gone up after that experiment of trying to eliminate the cash economy? Maybe, here we call it, underground cash, black market. So is the government doing better since they've made it tougher?
So it's a very, very good question. People might not have seen it in that same angle. We introduced something known as the GST tax, which is a singularization of all the state taxes and indirect taxes into a single tax, along with the demonetization. So when both these steps were taken, people initially thought this was bad. The fact is, post the pandemic and all the stimulus measures that everyone has taken, the tax revenues of the government in the last 1 year are way, way higher than anybody anticipated. So you hit it right there.
Okay. All right. So the season we're in with India being 8 years behind is what in India and what in the US? What would you?
So my sense is we are in the process of shifting between the winter to spring, and we may define this differently between economic discussion and between the stock market, because economically you would want to still see, oh, well, the debt levels are still high and they need to come down. But in terms of stock market, because at the end of a crisis like the GFC or like the banking one we saw here, you could have completed the winter in stock market terms, because most stocks crashed and had their panic reactions to the lowest point. And so the equity market is already past its economic winter. And it is doing what is known as wave 1 and 2, which is in Elliott wave sense, the first rally from our oversold condition on value buying, and then the second wave correction where people say, is it all really true? Are we still out of the woods or not? And that, I think that's the sentiment on the street. Whereas on the economic side, the reason I say that we have moved from winter to spring is we've gone from outright deflationary conditions in the commodity market to what I have called as reflation rather than inflation, because the monetary policy in combination with government intervention, which you also call as MMT or whatever name we may give it, is actually leading to an environment where prices of everything go up. So people say, inflation is bad. I say it's not just input costs that are going up, but it's also output costs that are going up and also labor costs that are going up. So in a sense, we are trying to bring down the debt to GDP by pushing up the price of everything in the economy. So that's a reflation and not just an inflation of some prices. And so it's a process.
Okay, so how has India been affected? What portion of this inflation or reflation And I don't think you could call supply chain issues reflation, because reflation to me implies intervention, blowing air into the balloon, right? So what about supply chain issues in India? Are they being greatly affected by price, especially when we come to things like agricultural commodities, Rohit, where grain prices have absolutely gone parabolic, and I don't think there's anything a central bank can do to bring down grain prices by raising rates.
That's right. So clearly, yes, interest rates cannot play a role in bringing down inflation that is related to bottlenecks. But India being a net producer of agro commodities, I think the impact becomes a little less. So we don't have like runaway food inflation out here, but we do have inflation at much higher levels. But our interest rates are also much higher than the US. So in that sense, but yeah, everybody, I think, including India, is running negative real interest rates. So no doubt about that. There's also a positive rub-off for India or some of the, like many of the emerging markets, because we are producers of commodities. So whether it is agro commodities, we are also metals, we do basic materials, papers,
Yes.
chemicals. We've started to get a lot of the chemical business where China was producing less. And there are a lot of incentives to make in India now given by the government, which are actually pushing people to start manufacturing for export. So actually, there's been a positive rub-off of all of this. There's been some impact of the, as you said, the bottlenecks on the auto industry where chips were not available for manufacturing. And so those pressure points were there. But most other parts have actually benefited from rising prices.
Okay, so you brought up the dollar and you're calling it corrective. And I'm curious what your take is, your count is.
So let me go through all the wave counts from
sure.
the Nifty, the Indian index, to then the dollar and commodities. Okay. So I have all of the charts coming up. Okay, so let me just swipe through them. Okay, so this is the big picture, and now this is an index of India which is backdated by an analyst in India all the way back to 1940s. And so I've tried to portray the 5-wave structure here and mark where the summer was and where the winter was. So the summer was in the 1990s for India, and US, the summer was in the 1970s when you had very high rates of inflation. India had the similar conditions only in the 1990s. So like I said, around 10, 12 years later. And then, of course, the winter period where we were correcting our debt problems went on till 2020. And so from there on, I'm trying to think in terms of, that we are in a spring. Now, when somebody looks at this chart, say, how can you say this is a spring? Because it looks like the market is rising. And there were a lot of attempts to change index components and make the market look good. So what I ended up doing, and a lot of people who are aware of how we study the economic cycle, is we either study it in terms of the index relative to gold or relative to the currency or relative to inflation. So I chose inflation, and I've divided the main index of India by India's inflation rate, which then shows us the long consolidation phases, which is this is your fourth wave summer, and this is your winter period, which is actually flattish because the Nifty did not go up as much as inflation during those years. So the best time to be in equities, as we all know that the best place to be to beat inflation is actually be in equity markets based on all historical studies. But when you do this kind of study, you also see when does that really happen? It happens during these bull markets. And that's somewhat of what has started from 2020, where equities are starting to outperform inflation. And so that is why I marked this as the winter phase, and what is starting now as a new spring phase for India. And I would say the same may have started for the US in 2009 in equity market terms.
Okay. Great look. Some viewers are going.
Another value measure for India is to simply look at what has happened. Like I said earlier, we've benefited. That shows up in our earnings. But because of all the recent market fears, of course, the Indian index is down. If you actually measure it in terms of retracement, this is only a 23% retracement of the entire bull run from the bottom. And in terms of our bank index, only a 38% retracement. What is interesting here, though, this is the PE ratio at the bottom of the pandemic sell-off in March 2020, and this is the PE ratio now. And you can see this big decline here is happening because of earnings growth. Okay, so we've seen serious expansion in earnings because of the reflation. But markets rose till this point, which is October, and then of course the tensions around interest rates and then Russia have pulled it back a bit, but it's a very, very small correction, like I said, in terms of only being 23% retracement.
Shallow.
So what I'm presuming here is possibly this bottom is done, and I'll come to charts relating to why. So let me just go to the next chart. This, of course, explains what I said earlier, whether the shift from spring to from winter to spring is done by governments taking a decision on whether they want to inflate the debt or whether they want to allow it to default. And I think right now the environment is to allow to inflate it, which is why they are keeping real interest rates negative. So even though they may be in a mood to raise interest rates, I think as long as interest rates are negative in terms of real interest rates, markets will find a floor somewhere and continue to try and move higher. That's my basic thesis. So this is the Nifty index in India, the long-term wave count. I'm presuming we completed the one super cycle, I think, into March 2020, which is why I've marked 1 and 2 over here. And
yeah, we've got a long way to go.
Yeah, we got a really long way to go. So we started something completely new over here from here, and I've called this wave 1. So we've completed the first wave of a new cycle. We are going through the second wave right now for the last 4 months. And I think we are due now to start, or I believe we've probably already started what is going to be a third wave, which will go, way, way higher from where we are.
Okay, nice look.
I mentioned in the beginning, I also use the momentum cycles. I've created my own momentum indicator to measure. And what I found historically is that when you're actually in a bull market, okay, in a serious bull market, then most corrections, so you see the momentum behaves in 2 ways. One is it has small cycles, like in a phase where the market's not really doing well, it has these small cycles. Same thing happened here when it was flat in the 90s, which is your summer. You have many of these small cycles. But when you're in a bull market like this, then you have an extended cycle with multiple whipsaws, buy, sell, where the market really finds good support is at one of the averages. In this case, the 20-month averages work pretty well in India. And we saw that happen again here in this next bull market from 2003 to 2008. The index went up 6 times and every sell-off found support at the 20-month average. Currently, that 20-month average was very close to around 15,100 for this month. Maybe it'll rise to 15,300, 400 for the month of April. And we made a low of 15,500 on the Nifty. So barely 300 points, 400 points close to the 20-month average, which is close enough, saying that the risk reward was very, very favorable at the recent lows.
Close enough for government work, no matter what who the government is. Or what country the government's from.
Yes. So I sense this was a good risk reward point. Presuming we are in a bull market, I'm presuming that this is a bull market wave 1 and wave 2, not just for India, but also for emerging markets in general, which charts of which I'll just come to. So initially I did think, when I was still in a deflation mindset, I did think, well, if we do rally on a lot of stimulus, we go all the way to this parallel channel, 18,800 and maybe sell off in a 5th wave, a view that I've changed. And we did get to 18,800 and got a correction recently, but now my sense is that it's a bull market correction. Now, moving to the dollar, so that's the central thesis of everything. This is, of course, a dollar index chart from 1970s pulled out from Bloomberg and other data. And it's had a 7 to 9 year kind of cycle, bullish, bearish, repeatedly. And so the last 9-year bull market cycle went from 2009 to 2017. And from there, I was sensing it may roll over. We got a double top into 2020, and then I believe we've rolled over. Even though we've had a sharp retracement, I think the dollar index is in the process of going into a 7-year bear market. So if I took the top at 2017, I thought it will go until 2024. If I shift the base and think, no, the final top is in 2020, then it will go until 2027 based on this timeline. So in terms of the wave structure, there are, of course, 2 possibilities. One, earlier I was thinking that the 5th top is in 2017 itself. But if I tried an alternate way, that let the double top be the end of the 5th wave, because you also had a lot of sentiment extremes. So this could be some kind of an ending triangle in the fifth wave. Then the decline we saw in 2020 is the first leg down, which I've said is an A wave, and we are pulling back and kissing this rising trend line from the 2014 and 18 lows. And that's also a 70.7% retracement. This 70.7 is essentially a square root of 0.5 for those who are not aware. So many times in currency markets, I've seen this retracement work. And so that's close to where we stopped on the dollar index, with, of course, a DSI of 92%. So my sense
even
is...
with the war, a lot of people are saying that, I think the euro's bottoming, but a lot of people say, well, this Russian-Ukraine war, it's not going away. I can't get long euro until I see, some type of resolution. What do you say to that?
Yes, so I have a euro chart coming up. So before I go to the euro, this is just for highlighting all the extreme readings in the dollar index on the daily sentiment index. So we had multiple ones in, I think, 1920, but it rolled over only after the spike from the pandemic. So now this is the euro, the complete opposite of that. At point B, we had a DSI of 8%. And at the most recent point, we actually had a DSI of 5%. Now, there's this thing in Elliott waves that psychologically, second waves sometimes make a higher bottom on sentiment that is as bad or worse than the actual bottom. So if we actually make a higher bottom for the euro here, which so far appears to be true, and we have a lower reading, this sort of fits the thesis that this is a second wave based on just psychology.
Also, you need this count to manifest to be right about your views on the emerging markets, right? This could be the match that lights a candle for emerging markets.
Completely, yes.
Okay, nice.
So as we speak of emerging markets, I then switch to the emerging market currency index. This one's shown pretty, it's held out pretty well, I would say. Possibly doesn't include, there are of course two emerging market indices on investing.com. The other one fell much more sharply. Maybe it includes Russia. Maybe there's more weightage there. This one doesn't show such a sharp cut because of the others. And so most of the currencies are pretty well held out, I think, in terms of the huge rally we saw in EM currencies post the pandemic. And then you had this small little ABC decline, which I think is mostly complete. If I draw a downward channel here, it should be a pretty clean one. If I take a very clear line, it should be something like this.
What's your preferred fiat in emerging markets? Do you have one or two that you think will lead, that you would speculate on?
Well, the one which is already leading, I think, is the Australian dollar. And the Brazilian real, and both may have to do with commodity price action because they're commodity producers.
Okay, thank you.
And of course, in the USDINR, that is the rupee itself, I do think we formed some kind of an ending diagonal pattern. So we were in the fifth wave for the Indian currency, the USDINR, for quite a while. It's really not sold off. It's come back to make a double top near around 77 during this Russian crisis. But it didn't go beyond that. So it sort of keeps us within this broader view. And I think once the next wave down for the dollar starts, you would see the USDINR pull back a lot more, possibly back to 65 or lower in the next bear market for the dollar. And that should be positive for Indian equities. Another thing I wanted to highlight in terms of reflation or hyperinflation, what we often see, and this is of course a chart of Turkey. We can see similar action in places like Argentina that has been perpetually hit by inflation. So when people don't understand why inflation is good for equities, I try to show this to them, that initially when you get inflation, markets do react negatively, as we see with the blue line. And that's because they fear that, rising prices would hurt some parts of the economy. But if prices keep rising and the currency starts to fall, which is what we've seen here in Argentina, in Venezuela, wherever you had hyperinflation, is that persistent inflation eventually leads equity prices much higher because the market starts to price in that, the entire GDP or sales or revenue of the companies underlying are going to be at a much higher level. So this is just to highlight that thought why we should be bullish equities in a inflationary environment, something that people often think that if there's inflation, it's possibly bad. I try to say that it's not.
Great point. Great point.
Now, this is a chart I've pulled from Elliott Wave International's recent reports, which is nothing but a ratio of the MSCI Emerging Market Index to the S&P 500, just to show that the ratio had come very close to the last time an emerging market bull started. So it's very close to that trigger point, and that then takes us to look more closely at what the EM indices are doing. And so this is the emerging markets, MSCI Emerging Markets Index, EEM, for those who want to look at investing.com. Right. And it formed a triangle between 2009 and 2020. And because of this triangle formation, I've marked it as a fourth wave, because fourth waves are typically triangles, not having historical data, but this is the easy thing that we would do as Elliott Wave analysts, that if you spot a triangle, you presume it's wave 4 or wave B. And given it's a long-term setup, I've presumed it's wave 4. And from that point, I've been looking for the bull run. So what we have, though, then is the first wave completing in the EM index, wave 1. And it was falling in wave 2. In fact, admittedly, I didn't expect it to break this channel on the downside, which it has done as the Russian crisis built in. But the beautiful part is the most recent low we've seen in March is an exact 61.8% retracement of wave 1. So we've gotten to that point. And so I would like to believe that the bottom for wave 2 is done now. And also I want to add that events like, so this is again studies or socioeconomic studies done by Elliott Wave International, which have shown that events like pandemics, wars, these crises have always led to or occurred along with major market bottoms. So that's important, because sentiment reaches an extreme. And of course, by the time the war is behind us, the market's not going to wait, which is why you need to really watch the structure and then take a call that the worst is over and start participating before the news flow changes. If you're really looking at timing a bottom in various of these markets. So that's looking at all those sentiment readings. I think that's where we are. We're reaching a very important bottom for markets, given the kind of news flow we've seen from the war front.
Your favorite emerging markets for this move would be what?
I think being in India, I will end up playing India, because that's the easy one for me to do.
Okay. So you'll be
if
long,
I think of
if I had appreciating currency and
then I would think Brazil. I would actually think Brazil, because that has done the best on a 3-year, 4-year time horizon in the past. And so and it's also done a deep 61% retracement of its rally since March 2020. So I would think
it's Brazil already started to rally in the last couple months.
Yes.
So okay, go ahead.
So as with the dollar impacting emerging markets, it should also impact commodity prices, which it has done. This is the Bloomberg Commodity Index, broke out of a long bear market in 2020 and has continued. The real question is, has it really topped out? Now, I think over time, everybody is aware that the commodity indices tend to have a large component of oil. So if I simply count this chart in terms of wave structure, I would start thinking that, we've done some kind of 1, 2, 3, 4, and are we really coming to a fifth? It is possible in oil, but it may not necessarily be in all the other commodities. Another thing is, in a bull market, you do get extensions. So should you stop significantly at 5, or will it continue to extend to 9? And especially if the dollar is rolling over, are there enough reasons for us to turn bearish on commodities? So possibly the only commodity I would be bearish from a couple of months perspective would be oil, because it has overshot to the upside, but not necessarily across the board. Agro commodities are still looking very attractive. And metal prices, I think you've seen big spikes in maybe nickel, but not so much in copper. And so I wouldn't take a stance across the commodity basket, turning too bearish. So here's a chart of copper, which shows a very long consolidation in wave 2 of what I think is a fifth wave going on. Again, because of the long triangle that we saw between 2007 to 2020. And I've circled a part in the last bull market, which shows how it continued to extend without, a deep retracement. So people often say, if you've marked wave 1, why shouldn't 2 be a retracement? the way I explain it is that if you have a short retracement in a bull market, it's a sign of strength. It's not really a sign of weakness, or that you keep waiting for a deeper retracement. So small retracements are actually a sign of strength.
Yeah, doesn't accommodate people. Okay, nice look there too. I'll stop trying to sell rallies and copper. Thank you.
So the only place,
last week.
yeah, the only place where I would think maybe we go through a correction or a consolidation is oil.
Yeah,
So
yeah.
oil also does count like 1, 2, 3, 4, 5 on this chart. Okay,
Yeah.
so I can say this is a. I'm not getting my annotation working. Why is it? Yeah. So if I take this as 1, 2, I've taken this as 3, 4 because it's also triangular.
Yeah.
So possibly this is probably the only commodity where I feel a fifth is done. Okay. And it may go into a second wave consolidation, which many others are doing right now, like copper is probably doing.
Yeah.
But oil hadn't done it earlier, and it may therefore keep gyrating. Something like this, if I just think in my mind, could be the case. It'll retest maybe the breakout point and then presumably start a third wave much later. So oil could be the odd guy out, and but I don't think other commodity prices will go into a huge correction.
All right. What a great presentation. Is that it?
Yeah, I think that covers the most significant.
I think yeah. I mean,
unless there are any questions.
Yeah, you didn't cover the zloty market, the Polish currency. I think that's the only thing you forgot. But great presentation. Thank you, whoever it was in our community that reminded me of Rohit, and you really clarified some things for me today. I appreciate your giving spirit and that you come here and share work that people could get great biases for and prep for these moves. I really appreciate it, Rohit. So I'm glad you came back.
Lovely, great. I really enjoyed being here and sharing these ideas. So thanks for the opportunity.
And yeah, and I'll get in touch with you via Twitter to keep you in the rotation, so we don't have this kind of distance between interviews. Okay.
Surely.
All right, everyone, and the best way for people to follow you and your work would be at India Charts.
Yes, indiacharts.com is the blog that I write. It's also an app on the iOS and Play Store devices. So if people want notifications on every update that we write, they can use the app to get it. And then, of course, all social media platforms, we are there as India Charts.
Okay, so follow Rohit, and you'll have a clear telescope. And most of all, don't just count your pips, count your blessings. And I want to thank everyone for their attention. Hope we've added value with our speakers and our views this week. And if you're grateful for it, try the Trader Funding Program. And I'll see you guys Monday. Adios, Rohit. Thank you very much. I'll be in touch. Have a great weekend, everyone. Recharge your battery because things aren't going to slow down this summer. See you later. And get ready for the equinox, right? The vernal equinox coming up next week. Spring, if you've been down a little bit, is the time of rebirth and the time to get back on track. And that's why I bring guys like Rohit in here. And I'll see everyone Monday. Thank you. And thanks again, Rohit.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.